Hello and welcome to the Opening the Gates October 2025 UK property market update, your most comprehensive overview of all things house prices and activity levels in the property market, October 2025 and year to date. So, a couple of bits that are going to be different today. Number one, I've got a stand-up desk these days. So if you see me moving around, that is because I'm not sitting down. And number two, I'm trying a new technique on Zoom which I believe is called over the shoulder, which sounds a bit weird, but we'll go with it. And hopefully that's going to make this a better experience for those of you watching. So as always, let's jump straight into it. And this is what I'm talking about with regards to over the shoulder. So hopefully you can see me on the screen, which looks really weird like that. So to start with, October 2025. So for those of you new here, left-hand side, we've got year versus year. Middle one, we've got month on month, and then right-hand column is October versus the 2025 October average. So we'll start with properties for sale. So properties for sale are up 3.2% year on year, slightly down on September at 1.2%. We will come onto that in a second, and 18.5% up on October average for 2025. So as I keep saying, we're seeing a 12-year average for number of properties for sale, but it's not oversupplied to market, as you can see by stock levels actually dropping a little bit on September. So actually we're in a pretty even market, quite balanced between buyer and supply. Obviously compared to the ridiculously low stock levels of COVID, they seem a lot higher. But if you compare it to the recession of 2008, they're actually considerably lower. So we're actually just in a pretty balanced market at the moment, which is definitely not a bad thing with all the uncertainty we've had and the uncertainty we've obviously got coming up at the end of this month with the budget. So new listings were down 1.1% year on year, 10.8% month on month, but slightly up on the 20 to 25 average. So a couple of things on that. Down year on year. This time last year, we would have had sellers anticipating, who typically would be buyers as well, anticipating they needed to get their ducks in a line and complete by March to avoid the stamp duty deadline. So there would have been probably a few more listings last year, but again, 1% change is minuscule. Month for month down almost 11%. You've got sellers who are hesitant in the market, understandably so. They don't quite know what's going to go on following the end of November. We obviously then got Christmas coming up. Are these sellers who are contemplating a move, are they going into hibernation for the winter and maybe they will reveal themselves in early 26, or maybe they make a move after the budget? And then 2.1% up on the 2025 average. So again, just a pretty stable market in terms of listing levels. Nothing too high, nothing too low, just pretty steady. Sales agreed year on year down 2.6%, up 5.5% month on month, and 1.3% up on the October average of the past half a dozen years. So down 2.6% year on year. Again, like I said, with new listings in October 2024, buyers were trying to get ahead of the stamp duty deadline. So again, not unsurprising that we're down year on year, but phenomenally, and this is an unbelievably resilient result. Month on month, sales agreed 5.4% rise, which is phenomenal considering all the uncertainty that is out there. That's an incredible result for the market. So it just goes to show properties priced correctly, marketed in the correct way, are finding buyers. Buyers are wanting to move, and you'll see that as I go through the update. And then 1.3% up on the 20 to 25 October average. So again, steady market. So really, really good numbers there. On to price changes, up 6.1% year on year, down 9.6% month on month, and 21.1% up on the 6-year average. So 6.1% year on year rise. So again, more properties coming to market, stock levels are higher, interest rates have not come down massively, so buyer affordability is still constrained. Therefore, sellers are having to adjust their asking prices because they're still being a little bit too ambitious to start with. However, month on month down 9.6%. Although I can imagine lots of estate agents and sellers are saying, well, price isn't the issue, it's because of the budget coming up as to why I'm not selling. And they're using that as an excuse rather than price. For anyone watching this, if you've not heard me speak on any podcasts recently or any webinars about the 6Ps, please do drop me a message to talk to you about it. Agents following this to the book, the 6Ps, are getting some fantastic results when it comes to price changes. And it's also something else I should add to that is actually I've not thought about this. It's just coming to my head now, which is random. But in terms of how to position the pricing as well ahead of time. So yeah, do DM me if you've got any questions about that. I've got agents using the strategy. It's working really, really well to get properties on at the right price. If they're not coming on at the right price, get them down and then getting them obviously sold. So withdrawn numbers, this is really, really interesting. So across the board, minus numbers, 38% year on year, 35.5% month on month, and 24.5% on the October average. Says to me, sellers are committed. Sellers are not leaving the market in their droves with the uncertainty over the budget and everything else going on. They're staying put and they're going, "Do you know what? No, we're committed to selling." So I think we've got a lot of serious movers in the market. So yeah, positive news there. We haven't seen, so actually I should check this. The withdrawn numbers are the lowest level I've seen since December 2022 off the top of my head. So it shows that we've got some really committed sellers. So go through those sellers. Who are the ones who really need to move? Get face to face, look them in the eye, have conversations around marketing and pricing. So there's definitely sellers out there wanting to move, and there's definitely buyers wanting to move, looking at sales agreed activity. It's just obviously matching their expectations on price. And a great Tom Panos line is for Mr. Seller, my job is to find a buyer out there in the market that agrees with the value you have on your property. So you've got to go out and find that buyer. And to do that, we've got to have more logical pricing, better marketing to bring that emotional buyer to the surface. And emotional buyers will pay the value typically that a seller is thinking of. Again, if you want to understand more about emotional versus logical pricing and the endowment effect, please do reach out to me. Right, fall through rates down 5% year on year, up slightly month on month, and down 5.6% on the average. So good news that it's down 5.5% year on year and the average. However, month on month, it has increased a little bit, which says to me some buyers or sellers are a little bit nervy about the budget. And if conditions are not perfect, sellers not found, it's taken too long, survey issues, etc., etc., people are quite happy to pull the plug. Reservation agreements, I say it every time. And I've got some interesting podcast episodes coming up with regards to how we can perhaps improve that as well. Relisted number down 33.5% year on year. Not unsurprising considering again the uncertainty. Sellers are just hesitant to come to market, particularly those who've tried before. They're just perhaps just waiting in the wings. Although this presents a great opportunity to target those withdrawn properties, because I think that if you're putting direct mailers into people's letterboxes now, you will see those listings in spring. Fact. So make sure you've got your board outside rather than someone else's. And the way you do that is to target the withdrawn properties now, well in advance of them coming back to market. Because I'm confident that once the budget and perhaps Christmas is out of the way, they will be coming back to market. 8.5% up month on month, so actually just proves my point there. But down on the 6 year average. There's some great stats from 20CI which highlights that once you've been on the market for 12 weeks or more, you only have a 14.5% chance of selling. Whereas if you come back to market, it's a 42% chance. Now, about 65 to 70% of sellers who come back to market change estate agents. Some have changed price, some have come on at the same price or higher. The chance of selling is pretty much the same. So it just goes to show that actually the estate agent can make all the difference. Certainly some data I would be using in my conversations, particularly my direct mail to on market or withdrawn properties right now. But yeah, if you go from a 14.5% chance to a 42% chance of selling, you've basically three extra chances of selling just by coming off the market and re-engaging perhaps with another agent. So those are the first metrics. Onto average asking prices. So year on year up ever so slightly. So just stable pricing on new listings. Pricing growth has been limited due to excess stock and affordability still being quite static. And down on September, which you would typically usually see. Pounds per square foot has shot up from 367 to 394. It's quite a bit of growth there on the pounds per square foot, but down on the 412 month on month. And then sales agreed average asking price down ever so slightly. So it just goes to show that those who are actually selling are the ones who are being realistic on their price. It's steady with the previous month as well. So yeah, it's really, really good to show sellers this because only half the properties that come to market are actually going to sell. So rather than concentrating on average asking prices of properties for sale and have been stuck there for 6 months, let's look at things that have actually had a sale agreed. And there's loads of different data tools you can use for that. Again, if anyone's got any questions, please do reach out to me. And then pounds per square foot, pretty steady, up from 345 to 351, both year on year and month on month. So slight steady growth there, which again highlights that if properties are correctly priced, marketed correctly, there is definitely demand for them. You look at the other asking prices for new listings, you look at price reduced data, just shows there's still too many sellers out there who are asking too much money for their properties, which is why, again, there's more reductions. Properties taking longer to go through. There's more fall throughs. So we've very much got a two-speed market. But I've heard a lot of different um, sources talk about Rightmove, Zoopla, Knight Frank Savills. I think all of them mentioned two-speed or two-tier market. The data from 20CI, I think, was 53.4% of properties are selling in the first 5 weeks. Why is it that half of properties selling in the first 5 weeks? Realistic sellers, priced correctly, have great marketing. Probably the other half have tried too much money and perhaps not had the best of marketing either. Right, on to mortgage approvals. Sorry, before I do that, actually, I'm going to just quickly do year-to-date figures. So whilst these are not on the screen, I'm just going to reel these off from my other screen. So properties for sale, up 7% on last year. New listings up 3.3%. Sales agreed up 4.4%. Price reductions up 12%. Withdrawals up 1.3%. Fall throughs up 7%. And number of properties re-entering the market down 5.5%. So year to date, we've got more stock, we've got more listings, we've got more sales agreed. So there's definitely positivity in the market. Although, again, there are challenges with more price reductions happening, slight increase on sellers coming off the market, and fall throughs are up quite a considerable amount. And then year to date versus the 20 to 25 year to date average. So that is January through to the end of October. Number of properties for sale are up 22.5%. New listings up 9.2%. Sales agreed up 3.3%. Price changes up 35%. Withdrawals up 13.7%. Fall throughs up 5.5%. And number of properties relisting to market down 2.7%. So across the 20 to 25 average, there's definitely way more property for sale. Sellers are coming to market, which is good to see, although sales agreed whilst up isn't quite matching the number of new listings levels, which is why we are seeing more price changes happen. As sellers need to be more realistic. Those who are not being realistic are then not selling, they're coming off the market, and property taking longer. Properties that have reduced are more likely to fall through, and we see fall throughs on the rise again. Another plug there for Gazille. In terms of asking prices as well, actually, um, on that. Year to date, new listing average asking price is down 0.2%, but sales agreed asking price up 0.5%. And the pounds per square foot, new listings up 3.2%, and sales agreed up 1.5%. So just pretty steady when it comes to pricing. Again, because of the pretty steady levels on mortgage approvals, transactions, new listing sales agreed, which we'll come on to, it means that pricing has been steady as well. And I will come on to it in a few minutes. But when you look at the UK government house price index, we certainly aren't seeing a double-digit house price crash that some people predicted a few years ago. I would have said at the time, we've got so much equity in this country in our properties. I think the UK property market is worth £10 trillion off the top of my head, and about 80% of that is equity. We were never going to see a repeat of 2008 because of stress testing and because of the level of equity that people have. So what we saw was, rather than prices coming down, is that people just sat on their hands and went, well, I don't need to move. So transaction levels dropped, which we observed in 2023. We're now seeing the recovery of 24, 25. 24, I think 1.1 million transactions, or no, did we have 1.15? I think we went from 1.1 in 23 to 1.15 in 24, and then we're perhaps going to see 1.15, 1.2 by the end of this year. A lot depends on what happens in the budget there. But according to Zoopla, I think we've got 350,000 sales going through the pipeline at the moment. Obviously, a lot of them are going to go into 2026, but we've still got hopefully 2 months, although a few weeks are shaved off with Christmas, obviously, as this is closing down. But yeah, I think we'll see somewhere between 1.15 and 1.2 million transactions in 2025. Right, mortgage approvals. So again, just going to go to my other screen to run through this. So mortgage approvals. For house purchases, increased by 1,000 in September to 65,900. That's the best month for mortgage approval since January, which is a phenomenal result considering the uncertainty we've got coming up. September mortgage approvals were up 1.85% month on month, 1.36% up on a 12-month average, 0.46% up year on year, and they were actually only down 1.13% on the 10-year average. So, as you can see from both graphs, apart from a couple of spikes, 2020 was obviously COVID. If I just scroll up here as well, you can just see how steady things have been, which is good to see. And then transaction numbers. So, financial number of monthly transactions. Let's just go to the other screen. So the financial number is 530,000. That is compared to 551,000 year before, and the 10-year average of 574.5. So slightly down there on the financial year, but on the 12 month, just go to this. So September transactions saw a 2.51% month-on-month rise and 3.66% year-on-year rise. This was the best level of transactions for September since 2022. As you'll see here, 2021 was the spike because of the stamp duty holiday. And then year to date, HMRC have reported 780,000 transactions. That was before the September data. Admittedly, that was 12.8% higher than 2024 and 2.9% higher than the pre-pandemic of 2019. So considering where affordability is now compared to COVID and pre-COVID, that's pretty good going. The other thing that I just want to share on this, so latest transaction levels were 3.62% lower than the 12-month average and 6.51% down on 10-year September average. So there is still some constraints around affordability pressures and cautious buyer sentiment, as I've said, but the month-on-month rise and year-on-year rise is really, really good to see. So approvals and transactions, whilst they're not setting the world alight, they're moving in the right direction, which is good to see. Inflation, 3.8%, which is, God, what is it? 3 or 4 months in a row now? Can't remember actually. Inflation, that's 3 months in a row now at 3.8%. So just shy of the 4% that was predicted. So a little bit lower, which is good, although it has remained pretty sticky and still almost doubled the 2% target. And inflation is at its highest level since January 2024. But we need to remember that late 2022, early 2023, we had double-digit inflation for the first time since the 80s. So yeah, we've certainly improved there. Right. Last but not least, house price index. So Rightmove average price up monthly 0.3%, down annually 0.1%. So Rightmove is newly listed prices. Zoopla at 270, 0.37% down month on month, 1.3% up annually. Land Registry at 273,000, up 0.8% and 3%, 0.8% monthly and 3% annually. Nationwide House Price Index 272,226, up 0.3% monthly, 2.4% annually. Halifax at 298,184, down 0.3% month on month and up 1.3% annually. eServe at 355,100, steady and then on a monthly basis and down 3% year on year. And then finally, home.co.uk 361,900, up 0.10% monthly and 0.6% annually. So the average sits at 314,547, up 0.12% monthly and an annual change of 0.79%. I won't go through the whole small print here, but if you do want to read the small print, it will be in my social media posts about the different house price indexes there, because some is on mortgage data, some is on completed data, some is on sold data, some is on newly listed data. That's why you've got a change in average asking price, which is why I do this report in my monthly update. But again, very steady in terms of the numbers there, so positive to see. Right, onto house price indexes. So probably last sort of 10 minutes now. So Rightmove house price index, as I've already said, 0.3% up month on month. Average asking prices are down 0.1% year on year. So they've said that agreed sales in the year to date are up 5% versus the same period in 2024, which is a positive sign. Now, if I just zoom in on this so I can read it better, there we go. Right. So the October average asking price, that was below the 10-year average October bounce of 1.1%. They say it's down to the decade high level of properties for sale, but it's limiting seller pricing power. September saw a softening of activity year on year compared with the strong September 24. I've already spoken about stamp duty. It was also boosted by the first bank rate cut for 4 years. It happened in the August, I think. And then the 2025 market has remained resilient, but there's certainly caution out there. So, a number of new buyers contacting estate agents for homes for sale, and a number of new sellers come to market in the 4 month September were down 5% compared to a year ago. However, year to date, new buyer demand is up 2% compared to the same period in 24, and the number of new sellers coming to market is up by 5%. With sales agreed in the year to date also up 5% compared to 2024. So there's some positive data there. Again, not setting the world alight, but some pretty stable levels there. And yeah, I think it's a pretty good market to be moving in. There's no like craziness going on with stupidly low stock levels or really high stock levels or really high interest rates or really low interest rates. It's all just pretty normal by historical averages, if you look at it. And I think the other thing that I'm going to touch on here, I've already said this, but if I highlight moving activity across the month of September has seen a dip compared to a busier period this time last year, which was fueled by the bank rate cut and in some home movers anticipating the April deadline for stamp duty increase. There's continuing jitters around the upcoming budget. That means that activity has not been strong enough to drive the usual autumnal bounce in prices. However, looking at the year-to-date data, market activity remains resilient, albeit there is some caution in some parts of the market, particularly above 500,000 with the tax reform speculation. Uh, right, I think there was a couple of other bits. I've already touched on most of this here. Um, the other bit I definitely wanted to talk about was this. I've spoken about it previously, but I can't make this clear enough. Rightmove research shows that homes which receive an inquiry in the first day of marketing are 22% more likely to secure a buyer versus homes which take over 2 weeks to receive an inquiry. So, funny enough, the quicker you get an inquiry on a property, the more likely it is to go on to sell. If anyone actually wants the full Rightmove data on that, please do give me a shout and I will happily share it with you. If I just scroll down to the bottom here, if we look at average stock is up on recent years, as you can see. Time to find a buyer. If you look at the other data as well, time to find a buyer is up. I've already probably said it, but it's about 10% longer to move. But the key thing I wanted to share was affordability trends. So whilst it is still more expensive to move on paper than it was a few years ago, if you look at the average mortgage payment on 10% deposit versus rent, it has continued to have a downward trending line. So those who are able to save a deposit are moving into market, which is why we're still seeing first-time buyers as the most active buyer group in the market, which is positive news there. Right, on to Zoopla. So Zoopla have currently got 1.3% house price inflation. Sales agreed are down 3% year on year. They're saying average time to sell is 37 days. Again, everyone measures everything differently, which is why it's important to run through all of this, because you never know what a buyer or seller might quote in the living room. So their executive summary, budget uncertainty is prompting buyers to wait and see, leading to the first annual decline in sales agreed in 2 years. Buy demand down 8% compared to last year, and sales agreed are down 3% as activity cools. More notable in a higher end of the market, as I've already touched on, a 7% more properties for sale, so buyers have got more choice. Average time to sell is 10% higher than a year ago, as I've already touched on, and as always, realistic pricing is key. And I've already said this, but 350,000 homes with a pipeline worth £100 billion are currently progressing through the pipeline, and that's the largest it's been in 4 years. So we've got the recovery period post Truss Kwarteng budget in September 22, but we've also got properties taking so long to go through. Rightmove and Landmark reporting 150 plus days to go from sale agreed to completion. So whilst there's been some positive recovery, things taking so long is why that pipeline maybe seems artificially inflated. So great summary from Richard Donald, as always. Budget uncertainty is driving a wait and see approach for new buyers, whilst committed movers continue to try secure sales ahead of the year end. Realistic pricing remains key for sellers securing sale. Let's zoom in a bit on this. Um, so just going to read through this. Uncertainty over potential budget measures in November is prompting many home buyers, especially those early in their search, to adopt a wait and see approach. First annual fall since October 23, as we said. Demand is down 8% on a year ago. Sales agreed down 3%. As the usual, pre-Christmas slowdown has begun several weeks early. Again, Rightmove said it. The dip also reflects the comparison with a strong final quarter of 24, as many rushed ahead to the stamp duty deadline. 7% more properties for sale, but there are committed buyers continuing to push ahead with purchases because I think those ones who are realistic have realised that they're looking for house prices to come down, interest rates to come down. That just doesn't, it's a perfect storm. It doesn't happen. One goes down, one goes up. So higher house prices equals lower interest rates. Higher interest rates equals lower house prices. You're going to be paying somewhere. So the best thing to do is to, rather than time the market, is time in the market. So sales agreed and buyer demand fall for the first time in 2 years. So as you can see, we had the slump following mortgage rates skyrocketing. We then had the rebound in sales. We then had the surge for stamp duty. We've then had it moderate. So again, it's not massively out of kilter, with what would be labelled as normal, if there is such a thing. Again, already touched on this, but the property tax speculation continues to hit the higher value homes. So there's a bigger decline in activity above 500 and a million. Zoopla's house price inflation, as I said, 1.3%, although it differs around the country. Time to sell is 10% slower than a year ago, up 20% in London. Already touched on the largest pipeline, so you can see there again, we've got the pandemic market just for opening. We've then got the boom 20 to 22. We've then got mortgage rates skyrocketing, and then we've had the recovery here. So outlook, Zoopla say that we're not far off the 10-year average of 1.2 million transactions, as I touched on earlier. They believe house price inflation will end the year at 1 to 1.5%. Modest house price growth is not a bad thing. It means that people can build up equity in their home, which should, in theory, stimulate more moves. So positive there. But again, the wider economic backdrop hasn't been strong enough to drive further growth in terms of sales volume in the near term and prices. But we're still seeing plenty of activity in the market. Final bit on it, the removal of stamp duty at the budget, the subject of ongoing media speculation, would no doubt provide a major boost to activity and support economic growth. However, plenty of buyers are cautious about what these new taxes might be and replace. Therefore, a lot of people are sitting on their hands. Right, nationwide. Let's zoom on this. So, slight increase in annual house price growth to 2.4%, up 0.3% month on month. So if I just read through what Robert Gardner said, because he's always on the money, October saw a slight rise in the rate of annual house price growth, 2.4% from 2.2% in September. Prices increased by 0.3% month on month. The housing market has remained broadly stable in recent months, with house prices rising at a modest pace and the number of mortgages approved for house purchase maintained at similar levels to those prevailing before the pandemic struck. Against the backdrop of subdued consumer confidence and signs of weakening in the labour market, this performance indicates resilience, especially since mortgage rates are more than double the level they were before COVID struck and house prices are closer to all-time highs. Looking forward, housing affordability is likely to improve modestly if income growth continues to outpace house price growth, as we expect. Borrowing costs are also likely to moderate a little further if the bank rate is lowered again in the coming quarters. Obviously, we've got the Bank of England meeting this Thursday on the 6th of November. I think it's quite evenly balanced between staying at 4% or dropping to 3.75%. I'll put my neck on a line. I think that we're going to stay at 4%, probably see a drop in February to 3.75%, but we'll see. This should support buyer demand, especially since household balance sheets are strong. Indeed, in aggregate, the ratio of household debt to disposable income is at its lowest for 2 decades. There's quite a few other bits in the house price index this month with regards to what home renovations increase value of a property. I'd strongly recommend checking that out. If we look at the house price index here as well, currently at 272, 2 years ago, it was at 259. So again, a strong growth there. So whilst people maybe in the past couple of years have waited for interest rates to return to what they were during or before the pandemic, as you can see, they seem to have sort of stabilized in the mm, mid to high fours, low fives. That seems to be pretty normal. We might get a bit closer to 4% as time goes on, but look at how much house prices grown. House prices have grown in that time. So people sitting and waiting on lower interest rates are being priced out of the market. Better to get in the market rather than wait. And then finally, we look at UK house price earning ratio. You can see how it shot up in the Trust Kwarteng budget period, and then it has steadily come down and it's in line with the 25-year average. So again, definitely people should be making moves from that. Right, Halifax. So Halifax house price growth at 0.3% drop monthly, up 0.4% quarterly, and a 1.3% annual rise. They currently have the price at 298,184. So Amanda Bryden of Halifax has said the slight monthly dip in house prices reflects a housing market that has remained broadly stable. I keep saying it's a stable market. Prices are up 0.3% since the start of the year. It's also important to remember that prices vary widely depending on characteristics like location and property type. As a result, many homes are available at a cost well below this headline figure. For example, those looking to take their first step on a property ladder, so a typical first-time buyer home costs just under 237,000. That's up 1.7% year on year, with pockets of even greater affordability to be found across different regions. That's why it's important to not only talk about the UK housing market, but the many hundreds, if not thousands, of micro markets that make up the market as well. So affordability does remain a challenge. However, relatively low mortgage rate environment compared to recent years and steady wage growth has helped support buyer confidence. Although the broader economic outlook remains uncertain, with affordability picture gradually improving, they continue to expect modest growth throughout the remainder of the year. There's a common theme here between everyone is that affordability has slightly improved, wages have grown, sales and listing numbers are steady, stocks quite high, things are taking a little bit longer, but there's just uncertainty around the budget and everything that has to do with that tax reform speculation, etc. Which is a common theme from everyone here. Right. It's Halifax done. Home.co.uk. I think there's only a couple of things to touch on here. The unsold sales stock count for England and Wales is at its highest level since October 2013. Oversupply has created a buyer's market in most regions. Seller hesitancy in an increasingly difficult market triggered a drop in supply of new sales properties during September. There are 11% fewer properties entering the market versus a year ago. And then this bullet point here, sales market momentum remains elevated compared to previous years. To date, this greater throughput has not been sufficient to significantly reduce the unsold stock total. So typical time of market for unsold properties is currently 3 days higher than it was in October last year, and it continues to trend higher. So if I scroll down to here, so average asking price is 361,900, monthly 0.1% rise, annual 0.6, and then time on market. Average time market for unsold property is 169 days. So almost 6 months. That is that. Right, eServe, always a quite negative one. I'm quite tempted to take it out of these updates because it is a little bit behind the times, it seems, as well. I have removed in the past Property Mark and Rick's ones because I felt they were too out of date personally. But Rightmove, Zoopla, Nationwide, Halifax, Home, and the UK house price index are definitely the ones to be going on. So they're saying monthly change has not happened, 3% down year on year. So these think there is a slowing housing market reflecting the falling confidence. Again, budget uncertainty is overhanging the market. The softening is likely to continue to the end of the year. I think that's a fair comment. Prices are in retreat in a number of areas. Definitely in southern England, where house price earning ratio and affordability is more constrained. Rob Owens, head of research, says that transaction volumes have stabilised. We've already seen that following the earlier distortions caused by stamp duty changes. Sales activity in July and August returned to typical seasonal levels, suggesting the market has now absorbed the impact of those policy shifts. However, whilst volumes have recovered, prices remain under pressure due to higher stock levels. Market sentiment continues to be weighed down by economic uncertainty, concerns over employment, and speculation around the tax changes in the upcoming budget. So interestingly, downsizing landlords are definitely adding to supply of the market and refinancing pressures mounting for borrowers. Price growth remains constrained. So yeah, there's definitely plenty of landlords looking to sell, although there are ones looking to invest. It's probably 15 to 20% of properties for sale are landlords. But about 10% of properties purchased are also buy-to-let investors. So I don't think there is a mass exodus as people think there is, but it's definitely landlords who are propping up the stock levels. And then if you look at the 20CI Q3 home movers report and survey, I think that's what it's called, and also check out the podcast I did with Katie Bellani from 20A. There is definitely pensioners looking to downsize, seeing an upward trend in that over the past 12 months. So yeah, if you want that report as well, drop me a message and I can send it over to you. Right, this is a good little graph. So let's zoom in. So the distortions in monthly pattern of property transactions caused by early changes in stamp duty has now unwound. I've touched on transactions earlier. So as this figure shows above, activity levels have recovered since spring, with housing sales in both July and August now in line with average levels. And we've seen that in September pretty much as well. While sales activity has improved, prices have been subdued in recent months, with sentiment increasingly affected by the uncertainty about jobs, the wider economy, particularly the nervousness around tax changes with the budget. Uh, these are bits I just want to touch on here. So just quickly run through that. So consumer confidence remains weak, and the upcoming budget is weighing heavily on the market in terms of demand. At the same time, downsizers are putting homes on the market alongside landlords who are releasing homes in their portfolio. Together, it's not any wonder the market is weakening because stock levels have risen. The reduced expectations of further cuts to the Bank of England base rate means that 2 million borrowers are facing refinancing their fixed rate loans. Some borrowers facing higher rates, so there's understandably tension there, and people perhaps not wanting to upsize and increase their mortgage. And that's been heightened again by the pre-budget airing of potential changes to taxation. Long-term house prices continue to be underpinned by the shortfall in housing supply. Again, if you look at the number of properties being built, whilst the government have pledged to build more and get to what was it, 3 million homes, the data's not backing that up. There's an estimated 2 to 3 million households waiting to become homeowners. With current contraction of the private rented sector, this potential demand could quickly begin to translate into activity with a consequent impact on prices. I think that's all I need to say there. Right, last bit, and then we are done. UK House Price Index. So August 2025, so this was published on 22nd of October. Average UK house price is 273,000, up 3% year on year, and the monthly price is up 0.8%. That is the end of the update. I think that how would I describe the market at the moment? Steady as she goes. There's lots of activity around transaction numbers, mortgage approvals, listings, sales shown. There is definitely appetite to move. However, the unrealistic buyers and sellers in this market, they're just not going to get moved. And I think my final point for those of you still watching is it is taking over 200 days to go from putting a property on the market to handing over the keys to the buyer. So what I'd be saying to anyone looking at the market right now, contemplating whether they should make a move or not, is that guess what? If you list your home in November, chances are if you are one of the 50 to 60% who end up moving, you're going to be doing it next spring based on 200 plus days. And guess what? Next spring, there will be another budget. There is a budget every 6 months. So whilst there is, of course, uncertainty around the tax speculation, if we look at typically budgets, elections, stamp duty holidays, major events, Brexit being another one, COVID being another one, what you tend to find is there will be a sit on hand approach of, oh my God, what's going to happen? More often than not, 9 times out of 10, the market will go on. It's incredibly resilient. So, thank you very much, as always, for watching. Stay tuned. In early December, I will be reporting on the November market update. We're doing some more year to date figures, and we'll obviously see has the market fallen off a cliff in November in the lead up to the budget, or are people still getting ready to move because they think the world's going to continue. So thank you again for watching. If you do enjoy watching these, please do leave me a review on Google. Make sure you hit the subscribe button. Check out my podcast on Apple and Spotify if you're looking to improve as an estate agent. If you've got any questions about what I've been discussing, or if there's anything you want adding next time, please do give me a shout. Thanks for watching.